Today we're discussing property strategies. The UK property market has so much to offer due to the potential for long-term appreciation and steady rental income. Data shows that over the past 20 years, house prices have risen from 180%. There's an extensive undersupply of housing here, with the gap only set to get bigger. So for investors, it presents great opportunities for strong returns and long-term value growth. The UK population is around 68 million people, and forecasts predict that the population will grow by another 6 million people in the next 15 years. And that's a lot of people who need somewhere to live. And house prices forecasts over the next 5 years are expected to grow even further by around 17%. It's a great time to be a property investor. As we support clients over the years, they diversify and choose more sophisticated, multifaceted strategies as their experience, wealth, and knowledge grows. And so what you ultimately decide to do is down to you. We're here to guide you and make sure you achieve your financial goals at every step, year after year. Let's start with my favourite, the Buy, Refurbish, Refinance Rent strategy, also known as BRRR. You buy a property, refurbish it, refinance it, and then rent it out. It's a popular strategy used to build ultra-profitable property portfolios. And here we leverage the power of finance to maximise return on investment. The benefit of doing this is that you're able to repeat the process over and over again. Instead of locking your money away each term in a single property, you can recycle the same capital into multiple properties over a period of time, which increases your net worth through creating profit in each property, and when held long-term, creates increased opportunity for capital appreciation over a wider asset base. Let's talk about property flipping. So flipping houses is one of the fastest ways to make a profit from property and increase your capital. This strategy involves buying properties at a low cost and selling them for a high price. The investor will purchase the property under market value with the intention of selling it for a profit rather than renting it out. An investor buys the property, adds value, and then sells as quickly as possible. Careful consideration is also needed to ensure you buy a property in the right area for the right price where there is demand. In many areas, there is a high demand for renovated properties, as most buyers prefer move-in ready homes. With property flipping, it's key to understand the 70% rule. So this helps you to work out if it's a viable investment. So first you calculate the after repair value, known as the ARV. The ARV is what the property is likely to sell for once value has been added. Calculate 70% of the ARV and then subtract the projected costs of adding value, plus other costs. So the result is the price you should pay for the property. So for example, if a property's after repair value is $250,000, 70% of that is $175,000. If the renovation costs and other expenses come to $30,000, then the maximum buying price is $145,000, which is the ARV minus renovation costs and other costs. It's important to consider all the other costs that might be relevant, such as stamp duty, solicitor fees, estate agent fees, survey fees, finance costs, insurance, and council tax. According to Check a Trade, the average cost to renovate a property is between £38,000 and £74,000, depending on the condition and specification of work needed. Property flipping can be hard work and time-consuming, so it's considered an active income rather than a passive one. But to put it simply, with flipping property, you buy low, add value, and sell high. Let's move on to title splitting. So title splitting is a legal process that divides property's title deeds into multiple titles, which creates separate properties. It's a popular strategy for investors to increase returns and add value to their portfolio. The process involves dividing a single interest into multiple interests, each with its own set of rights, interests and obligations. There are many ways to split titles. Subject to planning and change of use, investors could convert large houses into apartments or retail spaces. Some investors buy wholesale, so they purchase a block or multiple properties at a discount, split the titles, and then sell or refinance separately. So for example, if you bought a block of 8 flats for $400,000, completed a small renovation, split the titles and resold the separate flats each for $80,000, the total resale would be $640,000. Some investors choose to sell some and keep some so that they build their capital on the ones that they sell and then benefit from rental income from the units they retain. When title splitting is done well, you could expect 25 to 35% capital uplift in many areas. And in buying wholesale, investors often benefit from purchasing properties well below market value. Let's move on to purchase lease options, known as a PLO. A PLO can be useful when a property owner wants to sell but the market is slow, or when an investor doesn't have all the funds for a mortgage. A purchase lease option is a property agreement that combines leasing and purchasing. So it allows a tenant to lease a property with the option to purchase it at a later date, typically at a predetermined price. That being said, lease options can be complex. It can be hard to find properties suitable for a lease option, and there may be additional costs and extra charges too. Let's move on to a very simple strategy, single let. A single let strategy is where a property is purchased and rented to a single tenant or household. It can be simple to manage and offers consistent, steady income. Investors will benefit from any long-term appreciation of the property, and single lets seem to attract longer-term tenants, which results in lower turnover rates. Now let's move on to HMOs. You've probably heard this abbreviation before. It stands for Houses of Multiple Occupation. This is a buy-to-let investment strategy where a property is purchased and rented out to multiple tenants. A HMO is generally a property with at least 3 unrelated tenants who share common areas like kitchens, bathrooms and living rooms. Each tenant has their own bedroom and separate rental agreement. HMOs can be extremely profitable because they can increase rental value, provide a more stable income stream than single-let properties, and attract a diverse tenant base. However, with so much pressure on the UK housing market, there is a real need for affordable and flexible living. So let's move on to serviced accommodation. Serviced accommodation can be a very profitable investment strategy that involves renting out a furnished property for short-term or long-term stays, often known as a holiday let too. Serviced accommodation often comes with amenities like broadband, concierge services, and cleaning services. They're usually designed to attract travellers, business people, and people needing a temporary accommodation. Investors often use platforms such as Airbnb, Sykes, Cottages, Vrbo, and Booking.com to list their properties and secure bookings. The rental returns are significantly higher than single lets if occupation levels are high. For example, you may be able to rent a single let property out for $1,200 per month to a single tenant, but the same property could generate £100 per night plus cleaning fee when turned into serviced accommodation, meaning the same property could generate £3,000 per month. Overall, serviced accommodation offers significantly better rental returns than single lets, and investors benefit from appreciation when held long-term too. Now let's move on to commercial property. Commercial property is a wide asset class. Some popular types of commercial properties for investors can be retail buildings, industrial buildings, offices, and hospitality, to name a few. They can be a good investment that provides steady income because typically they're leased to businesses long-term, which provides a level of security for the investor. There's often potential for multiple tenants in one commercial property, such as offices, self-storage, and industrial units. As your knowledge, approach and skills grow, the size of your project will naturally evolve, reflecting your expanding expertise and confidence. Most property investors begin with small and manageable projects. These often include converting residential properties into HMOs, or they choose to buy, refurbish, refinance. This initial stage provides a great way to generate cash flow, grow capital, and gain experience. Land and property are incredibly valuable commodities, and to end on a light note, in the words of Mark Twain, buy land, they're not making it anymore.